Okay, let's get started. My name is John O'Donnell, and I'm going to be your moderator today. I'm Chief Knowledge Officer of Online Trading Academy. I think most of you are probably familiar with Online Trading Academy because of presentations made at FX Street by Sam Seiden, numerous and other instructors at Online Trading Academy, including myself over the years. And we're very grateful to have a content alliance with FX Street. And what we're going to talk about today, we will get into some discussion about the inflation-deflation debate. But what I'd like to do is take a macro perspective of what's going on in the world and show you how Online Trading Academy integrates the work of Sam Seiden and our faculty who developed our patent-pending strategy to time the market in virtually all asset classes for both short-term income and long-term wealth generation. Now, the examples we're going to look at today, and I'm going to show you we'll define our strategy, what it looks like, and then we'll add what's happening in a macro world on the inflation-deflation debate scenario. There's a lot more detail in my archive of webinars you'll find at the FX Street. Just do a search under my name, and you'll see that I've, over the years, opined on various major economic variables. And so today we'll brush up on that a bit and do a little bit of updating, but I'm going to show you a lot of trades today and how we've applied our supply and demand core strategy. Most of these trades come from various rooms that we host. But as most of you know, trading involves a high amount of risk, and past performance is not necessarily indicative of future results. Here at Online Trading Academy, we make no promises, guarantees, or warranties suggesting that any trading or training will result in a profit or will result in a loss. The content we're going to share with you today is copyrighted, is owned entirely by Online Trading Academy, and no reproduction or duplication or copying or distribution can be done without the express written consent of Online Trading Academy. So let's get started. There is a great perception versus reality out there when it comes to timing the market. If you really think about it, what you've been told, you and I were told our whole lives, is that you can't time the market, that it's impossible. We've been told, but if you really think about it, who told us this? We were basically told this by the Wall Street financial services industry. And this messaging really started after World War II. With the development of the retail development of the life insurance industry and the securities industry, specifically the mutual fund industry. Of course, Wall Street's solution in telling us that we can't time the market is that they can, and that they had a monopoly on this skill, and that you therefore should just turn your capital over to them, let them time the market. The problem with that whole model is that 95% of the mutual funds, in fact, underperform the S&P 500. So what Online Trading Academy did was go about developing, and we'll talk a little bit about our history, but we developed through our trading floor that really was started in Irvine, California in the summer of 1997. We started developing methodologies to time the market, be self-directed the market. We primarily started out as an equities trading shop, but we've dramatically diversified on the education side of the industry to options, foreign currency trading, futures trading, and of course equities trading. Now, the core strategy we're going to talk about today, many of you heard of our Chief Education Officer, Sam Seiden. We have to give a credit, a nod of the hat to Sam for bringing this strategy to Online Trading Academy. But it has been dramatically enhanced over the years by our 65 instructors, who collectively probably have in excess of 800 man years of experience trading the markets. As you know, Sam and his team have won numerous awards, not only at FX Street, but have been recognized and won awards at Traders Planet, the MENA Forex Award in Dubai, and various other, including Technology Investor Magazine. And we're very proud of those distinctions, and because they've been earned through merit. And there's a lot of competition in our space, and unless we were delivering through Sam's leadership a high level of service, we certainly would have earned these distinctions. Now, as most of you know, our strategy, if you paid any attention to Sam's work, is based on supply and demand of order flow, primarily is dominated by the institutions. I think most of us are familiar with supply and demand. It really became popular by Adam Smith in a book that was written previous to the Constitution of the United States in 1776. The title of the book was The Wealth of Nations. And this book really set forward the principles of supply and demand as, in fact, supply and demand rules the price change phenomenon on virtually all asset classes. Because of Sam's work on the floor as an order clerk handling institutional order flow, Sam developed a system, a strategy, a technique to use the transparency of supply and demand to find where institutions have high probability filled and unfilled orders. And what does that look like on a traditional price chart? So let's get into this a bit. You're going to find as we go through this that our core strategy, and I know this is a Forex-centric audience that we're talking to today, but in fact, our core strategy can be applied to very comfortably to these asset classes, equities trading, foreign currency trading, futures trading, and options trading. And when I say futures trading, I mean all forms of derivatives, as perhaps you're exposed to the energy sector, the precious metal sector, the base metal sector, or bonds. And you'll also find that our strategy works in all time frames. It really doesn't make a difference to us. So I want to show you some short-term and long-term trades today. Regardless if you're a day trader, a swing trader, or a position trader, you're going to find that our strategy works whether your role is to produce income or whether your goal is to manage your pension resources. Now, many of you come to trading. Some of you are new. Some of you are probably quite experienced at this. But we start out, many of our traders, with a model, an aspirational model to earn an extra $200 a day. Now, $200 a day is not an earth-shaking, life-transforming amount of money, but depending on your station in life, it can be a very substantial supplement or complement to your existing sources of income. Our message here at Online Trading Academy is you don't need to give up your day job to learn to be a trader. What you need to do is learn to fit it into your lifestyle. In fact, many trading vehicles, as many of you know, can find a print on a bid and an offer 24 hours a day, 5 days a week. But what size of capital do you need to get started? Well, if you wanted to make an extra $50,000 a year, and if you could find a bank reputation that could pay you 10% a year yield on your deposited funds, and there aren't too many out there that can do that today, he said, was tongue-in-cheek, you'd need about $500,000 of capital to get that kind of yield. Our recommendation here at Online Trading Academy is there's no reason in the world you can't start an account with somewhere in the vicinity of $5,000 And using our core strategy with discipline, focus, and passion, and being following our rule-based technique we'll go into here in a moment, there's no reason in the world you can't start an account with, say, as little as $5,000 with a broker of your choice, in the asset class of your choice, in the time frame of your choice, and there's no reason in the world you can't comfortably develop a plan that consistently will earn you about $200 a day. And we're going to take a look at what that might look like today. So in summary, our Online Trading Academy market timing core strategy will work for you if you want to produce short-term income or manage your pension resources in longer-term wealth protection strategies. So what are my goals today? My goals today are to familiarize you with Online Trading Academy, although there's a tremendous amount of information published on our website, and give you a summary view of our core strategy. And my goal today is to invite you to continue your training with Online Trading Academy, because we're in the short time that we have together today, which is about 45 minutes, we barely have, time to go into the basics. For those of you that live in the Southern California area, we're going to be hosting our market timing program. It's a 3-day, 8-hour-a-day class, October 2nd through the 4th and October 11th through the 13th in the Irvine, California area. Now, I know we have a global audience here at FX Street. I'm here to tell you, if you're not in the Irvine area, don't worry about it, because we do host this 3-day training program online, and we do host it in our 36 brick-and-mortar campus locations across 8 countries. So all you need to do if you want to come to our program is just go to our website, tradingacademy.com, and you'll see pick a center close to you, or simply come to our headquarters site and put in your location, and we'll find you an online course if you don't live near one of our centers. But what does our class cost? Well, our classes, we have multiple classes. They run 1 day, 3 days, 5 days, and 7-day experiences. And historically, the average tuition in Online Trading Academy has been over $1,000. But for any of you that would like to attend this 3-day class that I just mentioned, your tuition is only going to be $300. Now, if you we have an affiliate relationship with with FXCM, and if you're willing to open an account with FXCM, there is a way that you can come to this class for free. In other words, they will reimburse your $300 tuition that you would pay Online Trading Academy to come to this experience. So if you want more information on how that works, you can either email me, John, at OTAHQ, or you can contact an Online Trading Academy center near you, and you will get some information on how that works. Now, our recommendation is that you not give up your day job. Our recommendation is there are several headwinds our country faces that is going to create more global economic uncertainty and is going to create a lot of market volatility in multiple asset classes. So our recommendation is don't give up your day job. Our recommendation is if you're listening to this webcast, you probably have a passion to be engaged in the markets, but there's no reason you can't get started part-time, and there's no reason that you can't fit this into your lifestyle. And you don't need to limit yourself to just one time frame, one strategy, or one asset class. There's no reason in the world that you can't apply this to multiple asset classes. Now, let me give you an example of what I mean by that. I've done a lot of work as Chief Knowledge Officer of Online Trading Academy. I probably do more economic research and macroeconomic views than many of our short-term trading instructors. That being said, I think it's important to fit the macro perspective into your short-term day trading or swing trading trading plan. Now, I'd like to take a look at the equity market for a moment. Again, I know this is a foreign currency, but remember, equities are the price of earnings and cash flow in the private sector. And the financial health of a modern economy is dependent upon the private sector to efficiently produce, price, distribute goods and services. That is reflected, that economic health is reflected in the valuation of the equity market. And I'd like to put in perspective for you where I think we are today, because this chart, most of you probably haven't seen before, is the market cap in nominal terms of the U.S. equity market. And I'm taking the combined market cap of the New York Stock Exchange and NASDAQ as my proxy as a percent of nominal GDP. As you can see, the nominal GDP goes in this particular chart from 0% to 100%. And in time, this chart is looking at the price of equity or the valuation of the stock market as a percent of nominal GDP since 1924. Now, the red line that you see in the middle is the average. So at the end of the day, take a look at what is this chart showing us. Well, it's showing us that since 1924, regardless of what political party was in power, regardless of the innovation cycle, regardless if we were on a fiat currency standard, which we've been since 1971, or on a gold standard, which we were from 1924 through 1971, actually July 15th, 1971. Then Nixon took us off the gold standard. But regardless of what our currency was backed with, either, a tangible asset like gold or a political promise like it is today, which I'm not real fond of. But that being said, what's the market done? Well, it's fluctuated from a condition of overbought valuation, which would be above the red line, to a condition of oversold, which is below the red line. So I find this the trend. And if you want to know what the future is going to look like, it's going to look like more of the same. This is a well-established trend. And the good news for us as traders is that regardless of what's going on in the general economy, markets are going to fluctuate. And that price volatility gives us the opportunity to be long or short or even right options in flat markets to participate in this wonderful trading careers that we all enjoy. But let's take a look at the market today. Look since 2000. The real bull market really was between, the real bull market was between 1982 and 2000. Take a look at that. That was the real bull market. My position here at Online Trading Academy and perspective is that the real bull market is over. That since the first quarter of 2000, where the market peaked at over 180% of GDP, you've seen that we've been in decline. As a matter of fact, the market today is trading at about 122% of GDP, and that would reflect approximately 15,300 on the Dow today and approximately 1,700 on the S&P. Now, we have about $16 trillion of GDP in the United States, so the math is pretty simple. But if we were to connect those lower highs and lower lows that we've seen, those peaks and valleys since 2000, you can see that we are channeling back to the red line. Now, the red line is the average or the mean. And what do we know about markets short term? Well, what we know about markets short term is that markets mean revert. We may not understand the principles of root cause of mean reversion, but through observation, and thank God somebody's kept the records over literally hundreds of years, and perhaps thousands of years in some cases with commodities, markets constantly mean revert. That's a high probability trend is to mean revert. Now, note in March of 2009 on this chart, where the market got near, the last time it got near that red line, where the market had gone from roughly 180% of GDP back down to 72.79% of GDP, that we almost touched that red line and mean reverted then. We've had a nice rally since March of 2009, but as you can see, the market has started to turn lower and we are still mean reverting. So we've been in a 12.5-year mean reversion trend, and I believe that we're still in it. Another variable that I think we need to pay attention to is even though the nominal S&P looks like this picture today, we are in what we call a supply zone. And I would measure that supply zone on the S&P in nominal terms, because we're in about the same location we were in the peak in 2007 and the peak in 2000. And you have to ask yourself three questions. Given when, if we were to adjust this S&P for inflation, it would look dramatically different. But can you really buy and hold in a market like this? Because this market looks, for the last 12 years, much different than it did over the last 80 years. You know, are the banks and institutions selling at the tops? Well, yes, they generally are. And the third question is, with markets at all-time highs, have you been able to reach your income and wealth goals? And I would guess that most of you haven't. At least the people we see coming into the doors of Online Trading Academy that are hungry to learn this skill, with the Dow and the S&P at or near all-time highs, have not reached their financial goals, and they need, especially if they're a baby boomer, they have an ongoing need for more income. Now, the Online Trading Academy core strategy that we'll get into here in a moment has been an incredible tool to literally call tops and bottoms of markets. One of the best recorded, and I would encourage you to go to one of these Online Trading Academy education events and actually see the documentation in one of our trading rooms where Sam actually called the bottom of the market the day the market bottomed in what we call the demand zone in March of 2009 on the called the bottom of the S&P, and it's been remarkable the accuracy to use our core strategy with high probability to find tops and bottoms of markets in multiple time frames. Now, what could we add to this core strategy that would even enhance its functionality and accuracy? Well, a macro indicator I have followed for many decades, and I've been engaged in this market since 1968, is the New York Stock Exchange margin debt indicator. Now, let's take a look at this. There is a study that's become quite famous from our friends at Elliott Wave and through the leadership of Bob Prechter, known as the study of socioeconomics. Socioeconomics is the study of the change of social mood. Now, the fact that you're even participating in this webinar today, the fact that you're participating either as a trader of foreign currencies or you're an aspirational learner to develop the skill to trade currencies or any market participation, tells me that you are in fact expressing your social mood and your appetite for risk through your pattern of engagement. Now, I want to share something with you. If under the principles of socioeconomics, We know that social mood drives human action, and our human actions appear in culture in many different ways. It appears in the kind of television programming and entertainment with movies and music that we enjoy. It appears in our fashion. It also appears in our appetite for risk and our appetite for consumption. Let me show you what I mean by this. The principle of socioeconomics I like is that when people feel good, they buy more stuff. But when people really feel good and they're in a state of what Greenspan would have called irrational exuberance, they buy more stuff with credit. Now, this applies to the equity market. It also applies by your participation pattern to use aggressive leverage. Some would consider hyper levels of leverage to participate in the foreign currency market. But let's take a look at the New York Stock Exchange Margin Debt Indicator, which, by the way, has been computed for many, many decades and is published every Saturday in Barron's. And let's take a look at the history of the use of credit in the equity market to find peaks in market extreme valuations. In 1968, when margin debt peaked at 36%, the market then crashed 36% into 1970. With margin debt peaking as a percent of GDP in 1972, the market then crashed 48%. When the market peaked, with margin debt peak in 1987, the market then crashed to 34%. And then the 2000 margin debt peak, again on the left axis as a percent of GDP, the stock market then crashed 49% in the lows of 2002. And of course, the last time we saw this was in 2007 when margin debt peaked again, and we saw the market then crash 57%, which was the worst decline since the 1930s. Now, where do you think we are today? Go ahead, type into chat. What do you think? I'm going to update this for you in a moment, and we'll apply it to the S&P index. But where do you think the market's at today? What do you think margin debt as a percent of GDP relative to the valuation of the S&P? Where do you think margin debt's at today? Yeah, very good, Gino. It's right near the high, at an all-time high. Take a look at this. This is margin debt on the right axis in blue, comparing it to the S&P 500 S&P nominal price in red on the left axis. And look at the correlations between the two. We've got margin debt peaking in 2000, margin debt peaking in July of 2007, and margin debt, this is as of April 2013, and I'm here to tell you it is at the same extreme today. Matter of fact, a little more extreme, with the S&P bumping up against 1700. My work tells me that we are still in a secular bear market. The secular bear market, going back to that chart we looked at with the market cap as a percent of GDP to 1924, we have been mean reverting since first quarter of 2000. By definition, therefore, in either nominal terms or real terms, that is the Dow and S&P adjusted for inflation, we are in a secular bear market. And this rally that we've had since March of 2009 is really a cyclical rally of short-term duration within a longer-term secular bear market. It is my personal opinion that we are headed for a market correction. Now, we can debate the size of the correction. We can debate the length of time, but I believe we are well on our way toward another significant correction. And it's going to have big impact on the price of equity. It's going to have a big impact on the bond market. And as a matter of fact, the bond market very well may lead this. And it's going to have a big impact on the price of foreign currencies. especially the major currency trading pairs. We see in the United States that household income continues to fall. Household income, if I go to this is seasonal adjusted nominal household income, and there's about almost 2.3 people live per household in America. But if I look at per capita income in the United States, adjusted for inflation, income today is no higher than it was in 1989. So, here we are moving into our second decade of declining household income. In order, 72% of our $16 trillion economy is consumption. You need to have income for consumption. If household income, and we're not forming new households because most of the kids coming out of college today, at least 50% of them can't find a job. If household formation is weak and household income is anemic, as represented by these charts, you can see why the underpinnings of the fundamentals of the economy are not really doing very well, even though the S&P and the Dow are at or near all-time highs. That's strictly a function of the quantitative easing periods that we've gone through, and sooner or later, the Fed is going to be required to remove the punch bowl. Matter of fact, the fact that Bernanke just recently extended his quantitative easing program when everybody was convinced that he was going to taper is probably an indication that the data the Fed is looking at, it tells you that the economy is still quite weak. And this chart with anemic household income is telling me our economy is quite weak. Now, why is this important? Well, it's important because America is only 5% of the world's population, but we consume 25% of the world's goods and services. So we're a consumption-based economy. We're in much better shape than Western Europe on a relative basis, and we're in infinitely better shape than Japan. And I think we're going to see this trend continue to play out. So what are the solutions here at Online Trading Academy to participate in these markets? Online Trading Academy's core strategy differentiates the retail participation pattern from that of the banks and institutions. Now, most of us know from anecdotal information that the retail traders and investors are struggling at best to make profit, and most of them, in fact, are losing money because they're spending a lot of time paying attention to the pundits that are telling them to buy various asset classes, like this fella on CNBC. The problem with following those pundits is that, remember, those financial media, both print, radio, and TV, in fact, are simply supporting their advertisers. And they're not really the conduit to find success. So what else can the public do? Well, many of you have studied technical analysis. In fact, I've studied technical analysis for in excess of 30 years. And I've been with Online Trading Academy since 1998. And I have to tell you candidly, I really know of no one who consistently makes profits using traditional technical analysis. At Online Trading Academy, although we have a class on technical analysis, if you'd like to learn it, we're not big advocates of traditional technical analysis. Now, we use a few studies that you see on your chart right now in a very, very light version on top of our core strategy. And our core strategy basically uses the techniques that are used by Wall Street. Now, let's go into a bit of those. So I need to jump forward here a bit on my slides. and share with you our basic core strategy. The core strategy that we use is used by banks and institutions, and it's centered around institutional order flow. You know, if you really think about it, the key to becoming a successful trader, at least from the Online Trading Academy perspective, is that you get in touch with your buy and hold bias brought to you by culture and media, and start to think and act like an institution. Institutions, pattern of engagement is remarkably different, as most of you would imagine. But what does that look like? Well, it's what moves price. Actually, what moves price, and probably the best example, is the supply and demand for the iPhone. Now, I want to share something with you here. This is my new iPhone 37 slide that I think you'll find quite interesting. It does almost everything that a man would want. But that being said, I just saw a report, this iPhone that just came out. I think it's the iPhone 5. I think its retail price point is $400. Where it's trading for $3,800. Well, what could cause that? Well, supply and demand. What really caused the price change phenomenon of anything is, at the end of the day, supply and demand. And what we want to look for in the Online Trading Academy that we teach as part of our core strategy, which is our primary determinant on where we want to buy and where we want to sell, is what we call our supply and demand zone. So let's take a hard look at that. A demand zone for Online Trading Academy is a price zone on a chart where the willing number of buyers exceed the willing number of sellers. And that's usually dominated with institutional order flow. Now, what does that look like on a range? And then three large red expanded range candles appear and price falls lower. Now, why did price fall? Well, simply because the sellers overwhelmed the buyers and price fell down into that yellow zone, which we call our demand zone, as evidenced by the sideways movement in price, where supply and demand came back into equilibrium. And then all of a sudden, we see price rally back up and retest the origin of that downward movement. Well, we would call that downward movement a supply zone. And a supply zone is a price zone on a chart where the willing number of sellers exceed the willing number of buyers. Now, what does that look like on a price chart? Well, it'll look like this. We've seen that the buyers have overwhelmed the sellers, evidencing the origin of the move there on the left, those three big red candles moving down. We saw it move into our demand zone, and then price retested back to our supply zone, where, note that it did not go very deep into the zone on the first retest, and it didn't stay very long in that supply zone, as evidenced by those four candles, before that big red candle appeared, an expanded range candle, and drove it right back down to the demand zone. So at Online Trading Academy, we're going to use these supply and demand zones to determine the high probability turning points in the market. Now, I don't want you to get confused with the terms supply and demand with support and resistance. Support and resistance is different. You see diagonal support and resistance line on traditional technical analysis. We don't use supply and demand in the same way that you use support and resistance. We have a completely different method to define these terms. Now let's put this together in a sample trade. This particular case, we are trading the Swiss franc. These happen to be 5-minute candles. Well, this happened to be a trade taken from one of our trading rooms. We host, by the way, 10 different trading rooms, 2 hours a day, 14 days a month by multiple asset class. And they're very, very important to the ongoing education experience with our online trading academy, extensive global community, beyond the classroom work that we do in our learning centers across the world. But let's take a look at this trade. In this particular case, on the left, we see a big expanded range green candle leading us into the yellow demand zone. And then we see a rally in price coming out of that demand zone. What we're measuring in our supply and demand zones, and we do have a patent pending scoring methodology where we score our supply and demand zones 1 through 10 based on multiple variables we call our odds enhancers. And we're only going to take the lowest risk, highest probability trades in the zones that score 8, 9, or 10. Don't try this at home, by the way, on your own. You really need to come, even if you come to just one of our free seminars at one of our learning centers. You need to learn more about our scoring grid in order to properly identify these on a price chart. But let's take a look at the identification. We're not trying to make money when price leaves that demand zone the first time there on the left. What we're really doing is just simply drawing in the proximal and distal lines and to identify our demand zone. This particular zone, by the way, which would score about an 8 in our scoring grid, we're patiently going to wait for price to retest our demand zone. So, sure enough, price rallies, runs out of steam, and all of a sudden a decline starts there at the top, giving us drop-based drop, which allows us to identify and score our supply zone. Now, our supply zone, because of the way this is set up, using our odds enhancers, scored about a 9 on the Online Trading Academy scoring grid. So we want to buy at demand if and when price retests the demand zone. But what if price doesn't retest the demand zone? There's no guarantee it will. There is, however, under our scoring methodology, high probability that price will retest the demand zone, and if and when it does, we want to buy it in the demand zone. And there's 3 decisions we need to make. The 3 decisions as we see price approaching that demand zone are, I want to buy it in the demand zone, I want to turn around and have a target to sell it in the supply zone if I'm filled on my order to buy in the demand zone, and then I want to exit. So I want to know 3 decisions to make: where to enter the trade, where to exit the trade if I'm right, and where to exit the trade if I'm wrong. Now, my question to you is, what's the most important decision of those 3? What do you think's most important? Where to enter, where to exit the trade if I'm right, which would ideally be in the supply zone designated on the chart, or where to exit the trade if I'm wrong? Yeah, very good. The most important decision of the 3 is where to exit the trade if I'm wrong. Now, why is that important? Simply because that decision allows us to manage our risk. Well, note that we made about $978 on this trade. If these are 5-minute candles, we were in that trade about 50 minutes, and we were finished with that particular decision. Now, at Online Trading Academy, our goal is to teach you to use the direct access trading platforms and to have exposure to multiple asset classes in multiple time frames. I want to recommend that you contact an Online Trading Academy office near you. If you don't live near one of our global offices, and you can do that by simply going to onlinetradingacademy.com, you'll see a locations tab, and you can probably find an office near you. But I want to recommend that you go to an Online Trading Academy free event. We have free seminars. They're called Power Trading Workshops. We normally host them 2 to 3 times a week in our learning centers, and we also host them at least once a week free online. So all you really need to do is go to the Online Trading Academy website, register for a free seminar, and up will pop a menu of locations that you can attend for free, or you can even enjoy the free webinar that will go into much greater detail than what we have time to do today. But my name is John O'Donnell. I've enjoyed being with you today. I have lots of other webinars that are archived there on FX Street. I also encourage you to go to Sam Seiden's webinars. And yes, my email address is simple, john@otahq.com. Check out Sam Seiden's webinar archive. There's an extensive archive there on FX Street. Okay? And if you cannot get to one of our offices, we do host our classes online. We historically have not done that, but we recently launched an online learning division, and all of our core strategy with our instructors is taught in a classroom environment or online at your pleasure. God bless you all. Good luck. And I hope all your trades are green. Just go to the website. You'll find all the information you need.